Chapter 9 deals with fixed assets and intangible assets. As you recall or may recall, fixed assets would be those assets that have a useful life of more than 1 year. Typically equipment, automobiles, things of that nature that will last more than a year. Of course, fixed assets are typically used to produce income. That's why many companies will acquire fixed assets. And as a result, they will lose their usefulness over time. When a company buys a fixed asset, it may include more than the cost of the asset. Some of the other costs associated with acquiring a fixed asset could be installation of the asset, transportation costs to get the asset to the plant or the building, things of that nature. Repairs to assets, fixed assets, typically are recorded as an expense. However, when the repair actually will increase the life of the asset, it's referred to as a capital expenditure, and the general journal recording is a little bit different. The nature of fixed assets are that they lose their usefulness over time because they're used to produce income. So a truck that I buy today, in 2 years from now, is not going to be worth as the truck was when I purchased it. The way we reflect that fact in accounting is called depreciation. We will cover the journal entry in some detail in the chapter, but basically we debit depreciation expense. That's an expense, cost of doing business, and we'll credit an account called accumulated depreciation, which is a contra asset account, meaning it has a balance contrary to the normal asset balance of a debit. Rather, it will have a credit balance. The last thing we look at in the chapter are intangible assets, patents, copyrights, trademarks. And we'll spend a little bit of time on this, but some of the issues associated with intangible assets would be determining the cost of the asset and also determining amortization, which is the same as depreciation, only for intangible assets we call it amortization.